a new business week. Welcome to Business Morning on Channels Television. I'm Chimeze Obi. Well, the week is starting with a number of economic data releases from Nigeria and globally, as well as a number of business events. Now, a closer look at the calendar for the week shows that the National Bureau of Statistics will today, Monday 29, release the daily energy generated and distributed for third quarter 2018. The Nigeria Trade and Investment Summit is also scheduled to hold in Lagos. On Tuesday, October 30, the second annual Traders, Investors and Analysts Meetup 2018 will hold in Lagos with the theme Trends, Study the Past, Understand the Present to Forecast the Future. On the global scene, the Eurozone is set to release the consumer inflation numbers on this day. And there isn't much on the local scene for Wednesday, October 31, but on that day, the Bank of Japan will release its outlook report year on year. On Thursday, November 1, the WIMBY's 17th annual conference will commence with the theme, The Future is Here. That same day, the 2018 LCCI International Investment Conference, which has the theme, Promoting Investment, Connecting Businesses, will hold in Lagos. The Business Solutions Expo and Conference will also commence on that day in Lagos. And on the data front for that day is the PMI numbers here in Nigeria. We'll track PMI from CBN and FBN Quest. The United Kingdom will also release its Manufacturing Purchasing Price Index on that day. But on Friday, November 2, Germany is set to release its Import Price Index for September. And on Saturday, November 3, the National Bureau of Statistics will release the pension asset and membership data for third quarter 2018. Well, that's pretty much what the week looks like, and we'll keep track of some of those data throughout this week. And last week, the Federal Executive Council approved the government's 2019-2021 medium-term expenditure framework and fiscal strategy paper, which proposes 8.73 trillion naira expenditure for the 2019 budget. The government forecasts GDP growth of 3% next year and assumes oil output of 2.3 million barrels per day, crude oil price at $60 per barrel, and an average exchange rate of 305 naira per dollar. And joining me now to look at this framework is an economic and financial management consultant and the chief consultant, B. Adedipe Associates, Dr. Biodo Adedipe. Good morning, Dr. Adedipe. Thank you very much for joining us.
Good morning. Thank you for having me.
Now, looking at the MTEF 2019 to 2021 that was released yesterday, what do you make of the timing, considering that the Fiscal Responsibility Act stipulates that MTEF be presented at least 4 months before the next fiscal year?
Well, really, I think where we are today is a reflection of how we have managed the process of fiscal policy formulation and indeed the conclusion of that process in the last couple of years. Now, looking carefully at what has happened, usually the budget gets signed into law about mid-year. So in which case, you have 1 year rolling into the order, and so we keep, therefore, ending up with not following strictly the requirements and stipulations of the Fiscal Responsibility Act. But be that as it may, the key issue is what we do from this very moment. Because if we see it as strategic enough and important to the economy, and there are two issues here in actual fact. The MTEF not only serves as the plan of the government, it is also a signaling document, which means it gives us an idea of what government wants to do, but on the other hand also signals to us the likely direction, which is what the private sector needs. So it is quite important from those two perspectives. So if we recognize that, then we won't talk about it not coming out in time as expected in that act, but that we need to expedite action now that it is out.
Okay. Now, looking at that plan there, the expenditure is down 5% from the 9.12 trillion planned in 2018. Is this a recognition that the economy is under pressure as the country struggles to meet revenue generation?
Well, there are so many different ways to interpret it. And that also takes from what I said earlier. that it should be seen also as a signaling tool. Now, one aspect to it is that, yes, it is real, the revenue is not coming in as projected. That's a reality that we face today. So the government also taking that into account in moderating the expectations makes a lot of planning sense. Then the other side to it is that when you look at the recent pattern with the inflation rate turning northwards, it also gives some measure of need for caution, which means, is there a possibility of striking a balance and coordination between the monetary policy, whose primary consideration is inflation targeting anyway, now side by side with fiscal operations? So, and I think this also sounds nice in that wise. And of course, coming to also look at priorities, which details will of course come later when we see the actual budget itself.
Now, the fiscal authority over time, has embarked on borrowing to fund the budget. What's your take on this borrowing strategy, considering that, of course, the monetary policy alone cannot actually spur up the economic growth?
Yeah, really, for me as an analyst, I would say in the last 3 to 4 or 5 years, monetary policy has actually carried more burden than it is supposed to have carried. The other side of it is that, yes, fiscal operations have been expansionary. But once you embark on that, and don't forget, 2 years ago we were in recession anyway, so but coming out of that meant we needed to spend more to get ourselves out of that trouble. Now, once you get to that point, and there is that worry by most economic actors, and that is talking about private sector organizations and even individuals holding back from spending, the government needed to step in to do that. So it made a lot of sense in terms of economic management for government to spend a lot more than the resources available to it. So inevitably, therefore, to borrow. But the principal question to ask here is borrowing for what? So what we see also in recent years is a departure from the past. And when I say the past, I'm looking back at, say, some 40 years ago, when Nigeria first ran into this trouble, what we call the jumbo loans in 1978. So if you look back at that till date, you find that in recent times, most of the loans we take are targeted at projects and especially infrastructure that can now enhance productivity on the one hand and also make the business environment more conducive for private investors, which really I think is the real good direction. But when you now take data also, looking at what we have as a sovereign debt, which of course are two major components, local and foreign, when you look at the bulk figure itself, vis-a-vis our GDP, you get some bit of comfort, especially when you look at what is happening around the world. Countries that either have developed or they are emerging, or even those who belong in the group Nigeria is in recent times also, grouped with the frontier economies, you find that most of them have debt GDP ratios that are in fact much higher than Nigeria's. So what we should be asking ourselves and giving more attention to is what are these borrowings creating for Nigeria? If they enhance productivity and therefore enhance our capacity to generate not only more revenue in dealing with the rest of the world, that is exporting, but equally in producing more locally to strengthen internal trade, then I won't have any worry about it.
Anyway, let's just leave that at this point. I'll be having Mr. Rwani later to dwell more on this particular issue. But let's look at some of the assumptions of this MTEF. We begin with a GDP growth rate of 3.01. Is this not optimistic, considering where we are?
Well, I don't see it as too optimistic. And my reason for saying that is this. If we look at where we got to before there was a dampening in terms of the growth rate slowing a little to less than 2% per annum, you find that, yes, the economy has been growing quite all right. It is still growing quite all right. What has happened is that the rate of growth has slowed a little bit. So if we are able to get over the slowdown in economic activities that normally is affected in a pre-election year, like the year we are in now. So by the time we get to the elections in February, hopefully by April, we should be done with all the protests and whatever, court matters on it. And then we are now ready to get back into business. So having 8 months of the year out of 4 to do good business after the election matters have been settled, I believe can ramp up economic activities, especially with the investments we have done already with respect to infrastructure. Okay. So I think it's realistic in a way.
Okay. Now look at the oil benchmark of $60
right, 60,
per barrel. What's your
That
take?
also appears realistic to me, and I will say this from the point of view of data. Now, looking back at data in the last 20 years, that is crude oil price and the average for every year, and then the point data at the end of every pre-election year and immediately after election, since the last 20 years as well. When you take all of those into account, you find that in the last 3 to 4 years, we've had the price of crude oil more above $60 per barrel than below it. So, and again, the other side to it is, apart from the historical data, you also look forward. What is likely to happen on the global scene that will affect the price of crude oil? Again, there is nothing that sounds negative in the horizon, except to consider that, there's a lot of activity going on in alternative energy, all right? So, but even at that, it has not gained such traction enough that can affect the demand for fossil fuel. And therefore, to that extent, we don't expect any massive adverse effect on the price of crude oil. So there's a likelihood, therefore, that at average for the year, we are still likely to see a figure above $60 per barrel. So $60 per barrel assumption here makes a lot of sense to me.
Okay, we've seen the oil price as high as $80.
That's right.
Now, and do you think the Nigerian government is actually doing enough to tap into this opportunity of higher oil prices in developing the economy?
Well, really, the key thing about the price of crude oil being high is matching that with what you produce and then what you also sell. Now, it is one thing to produce and another to sell. And I'm talking about the export side. But if you look at the oil arithmetic in Nigeria, I mean, let's even roll it back to 40, 50 years. There's a pattern of relationship between production and export. So if we look at the assumption of 2.3 million barrels per day in the MTEF, vis-a-vis the usual projection for export, we could be looking at export between 1.8 and 1.85 million barrels per day. So which means if we can keep to that production figure, we should be able to export that much. And don't forget also, within this period of 3 years of the MTEF, is when we expect the Dangote refinery to begin operation as well. So that will also take a part of that crude that we produce, and that can bring some measure of stability to that sector in terms of what Nigeria earns for the production of crude oil.
Now, the exchange rate is pegged at 305 naira per dollar. How realistic is this when the rate has been around 360 for a whole year?
Well, there are two things here. One is, yes, roadside market, 360 naira at times 363, 364 to a dollar. Official rate has remained around 305 naira to the dollar. Now, for me, when I saw that number, I told myself that this is a signal that the government does not intend to devalue the naira. And that's a very strong signal. Now, which is why I started by mentioning the fact that MTEF serves two purposes: planning for government and then signaling for the private sector. So for me, 305 is a signal that this government does not intend to devalue the naira. So for those who therefore are speculating that there will be devaluation and therefore they can make a windfall gain, let them still hold on to their dream because it could remain in the pipe. So that is my interpretation of that, which means then that if we are able to strengthen the key sectors, agriculture, manufacturing, in such a way that we reduce what we import in those sectors, there is the likelihood also that government will be able to sustain that. And of course, what you have to then worry about is the vagaries of international investors who move in and move out, and therefore can affect what you have as your external reserves.
Okay, just a quick one before I let you go. What are the possible risks to these assumptions here?
Well, the key risk for Nigeria as of today and looking to the near future still remains the oil sector, because primarily our economy still depends on oil. And that is why if you look at those assumptions, a lot of them are around oil anyway. So in which case, the key risk that the government needs to pay attention to is production of crude oil, associated gas, and of course condensate. That means we need peace in the Niger Delta. They must invest in peace. And equally, they must invest in encouraging, like the Minister of State for Oil did last week, to encourage international investors to commit fresh funds into oil assets investment in Nigeria. So that's the main risk for me as far as this is concerned. Well managed, then we are good to go.
Thank you very much for your time, Dr. Adedipe.
It's my pleasure.
I'll be speaking to Dr. Biodo Adedipe, Chief Consultant, Biodo Adedipe's Associate, Dr. Biodo Adedipe. Well, let's take another short break, and when we come back, we will continue the conversation on Nigerian economy with a closer look at how to resolve some of the constraints and imbalances. So stay with us.